wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This here is the Market Color Podcast, where we keep you up to speed with the latest developments in the financial market. And we do that by first giving you a broad overview of the global financial markets, so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week, so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 165, and in this episode we're reviewing the performance of the global markets during the 25th week of 2025, and that is from Monday the 16th to Friday the 20th of June. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off on the global scene as world leaders reacted to President Trump's announcement on Saturday that the US had carried out an attack on 3 nuclear sites in Iran, including Fordo. Meanwhile, China strongly condemned the US attack on Iran and on nuclear facilities supervised by the International Atomic Energy Agency. In a statement on its foreign ministry website, China said that the US attack seriously violates the United Nations Charter and worsens tensions in the Middle East. China urged parties to the conflict, especially Israel, to cease attacks as soon as possible and begin a dialogue and negotiations. Elsewhere, the United Nations Secretary General Antonio Guterres warned that the US strikes on Iran represent a dangerous escalation in an already volatile region, posing a serious threat to global peace and security. Over to the United States, where on Wednesday the Federal Reserve kept its benchmark policy rate steady amid expectations of higher inflation and lower economic growth, and still pointed to at least 2 rate reductions later this year. With markets expecting no chance of a central bank move this week, the Federal Open Market Committee kept its key borrowing rate targeted within a range of between 4.25% to 4.50%, where it has been since December 2024. Along with the rate decision, the committee indicated that 2 rate cuts were still on the table by the end of this year. Economic projections from meeting participants pointed to further stagflation, which refers to both slow economic growth and rising inflation happening at the same time. Members of the committee project that the gross domestic product will slow down to 1.4% in 2025, with inflation rising to 3%. In the United Kingdom, on Thursday, the Bank of England kept its policy rate on hold at 4.25%, with economists expecting the central bank to wait until August before it begins cutting rates once again. 6 out of the 9 Monetary Policy Committee members voted to hold the rate steady, with the other 3 members opting for a 25 basis point rate cut. In its official statement, the Bank of England said that the underlying UK gross domestic product growth appears to have remained weak and the labour market continues to loosen, meaning that unemployment was rising, indicating that there was room for further easing of monetary policy. The central bank warned that global uncertainty remains elevated, with energy prices rising due to the escalation of conflict in the Middle East. Staying in Europe, on Thursday, the Swiss National Bank cut its benchmark interest rate by a further 25 basis points, down to 0%, raising concerns over a potential return to negative rates in Switzerland. The central bank said in a statement that inflationary pressure had decreased compared to the previous quarter and the easing of monetary policy to 0% was necessary to counter the deflationary trend. Whilst other nations continue to battle inflation, Switzerland faces deflation, with consumer prices falling by an annual rate of 0.1% in the month of May. Low levels of inflation are not unusual for Switzerland, with the country having experienced several periods of deflation in the 2010s and 2020s. For your information, the strength of the country's currency, that is the Swiss franc, is a major contributor to this deflationary trend. On Wall Street this past week, the S&P 500 fell on Friday as investors monitored the latest developments out of the Middle East. Traders also contemplated the path of future interest rate cuts by the Federal Reserve as the S&P 500 started off the trading session higher after Federal Reserve governors said that the central bank could cut interest rates as early as July. This was in contradiction to what the Fed Chairman Jerome Powell said on Wednesday, and that was that the central bank was in no hurry to cut its policy rate and will remain data dependent, especially due to the uncertainty about how tariffs will impact the U.S. economy. Friday marked the third consecutive losing session for the S&P 500, which declined by 0.2% to end the week at 5,967. Meanwhile, the tech-heavy Nasdaq Composite dropped by 0.5% to settle at 19,447, and the Dow Jones Industrial Average ticked up marginally by just 35 points to close the session at 42,206. In the U.S. government bond market, the bond markets also continue to monitor the conflict between Israel and Iran and the remarks by President Trump that he was considering direct intervention in the conflict. Longer-dated U.S. Treasury yields fell on Friday after a Federal Reserve governor said that inflation was softening to the point where the central bank could cut interest rates at its next policy meeting in July. That comment came 2 days after the Fed left its key borrowing rate unchanged at between 4.25% to 4.5%, with the policy setting committee anticipating higher inflation and slower economic growth. The yield on the 10-year Treasury bond was down more than 1 basis point at 4.37%, whilst the yield on the 2-year Treasury note fell by more than 3 basis points to settle at 3.90%. For your information, 1 basis point is equivalent to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the foreign exchange market, on Friday, the US dollar rose to a 3-week high against the safe haven yen and gained ground on the Swiss franc on the back of escalating tensions in the Middle East. The dollar index, which measures the strength of the dollar against a basket of 6 major currencies, was on track to appreciate by 0.6% this past week. However, the index was flat on Friday after a Federal Reserve governor said that rate cuts should be considered as soon as July, given the recent trend in inflation data. In the commodity markets, the price of crude oil fell by about 2% on Friday as President Trump initially indicated that the U.S. would hold off on attacking Iran's nuclear sites. However, all that changed on Saturday when President Trump announced the U.S. had carried out a series of attacks on 3 nuclear sites in Iran. When trading resumes on Sunday evening, the price of crude oil is expected to shoot up by about $5 per barrel, with gains expected to accelerate if the conflict escalates and causes a major disruption in oil supplies. When the markets closed on Friday, the price of the global benchmark Brent crude had settled at $77 a barrel, whilst the price of the U.S. benchmark West Texas Intermediate crude was recorded at $73.84 per barrel. In the precious metals market, the price of gold was steady on Friday and poised for weekly loss after the U.S. president initially indicated that he would delay his decision on entering the conflict between Israel and Iran. However, this scenario has since been overtaken by events, and we expect gold to appreciate sharply on Monday morning when trading resumes as investors flock into this safe haven asset. Meanwhile, the U.S. Central Bank held interest rates steady on Wednesday as policymakers still anticipate cutting interest rates by at least 50 basis points this year. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't provide a regular yield like a bond. The price of spot gold was down by 1.8% for the week and touched its lowest level since the 12th of June before settling at $3,368 per ounce. We now change scene to the Kenyan financial markets. And as is the norm, we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained static versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.28 compared to 129.24 that was recorded the previous week. Meanwhile, the sterling pound was priced at 173.26 and the euro was valued at 148.21. And on the regional front, one Kenyan shilling was changing hands for 27.85 Ugandan shillings and 20.23 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.04. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product, and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined marginally by $33 million for a grand total of $10.91 billion, which is equivalent to 4.8 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. On diaspora remittances, the inflow of remittances in the month of May 2025 amounted to $440 million, reflecting a growth of 4.1% from about $423 million that was recorded in April 2025. The cumulative inflows for the 12 months to May 2025 increased by 11.6% to $5.03 billion compared to $4.51 billion for the corresponding period in 2024. The steady growth in remittance inflows continues to support the country's current account position and provide stability in the domestic foreign exchange market. The United States contributed 57% of total remittances in May 2025 and remains the main source of remittances for the country. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the interbank market. The average interbank rate, which is the rate that the banks lend to each other, mainly on an overnight basis, this dipped slightly by 7 basis points from 9.72% the previous week down to 9.65%, which was still pretty much in line with the central bank rate at 10%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 12.9 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 19th of June, and the central bank received bids totaling to 27.3 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 114%. The central bank ended up accepting 24 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 1 basis point to average out at 8.16%, whilst the 182-day rate declined by about 2 basis points to settle at 8.47%, and the 364-day rate ticked down by 1 basis point and came out at 9.73%. In the primary bond market, in the month of June, the Central Bank of Kenya was looking to raise a total of 50 billion shillings through the sale of two reopened fixed coupon treasury bonds, and the auction for these bonds was held on Wednesday, the 18th of June, and the central bank received bids totaling to 101 billion shillings, but ended up accepting 71.6 billion shillings, and the results of the auction were as follows. The Fast bond, which is a 15-year bond with 9.7 years left to maturity, that is in 2035, the central bank accepted 57.8 billion shillings at a weighted average rate of 13.48% compared to the bond's coupon rate at 12.75%. For the second bond, which is a 30-year bond with 15.7 years left to maturity, that is in 2041, the central bank accepted 13.7 billion shillings at a weighted average rate of 13.99% compared to the bond's coupon rate at 12% flat. Up next is our topical issue, and this week we're looking at the reduced demand for loans from the private sector. Commercial banks are anticipating suppressed demand for loans from the private sector in the 2 months ending July 2025 as they remain under pressure from elevated cost of doing business, low disposable incomes, as well as concerns over taxation. The latest market perception survey published by the Central Bank of Kenya notes that the impairing factors will water down the gains that ought to have been derived from lowered interest rates and gradual recovery of the economy. If loans to the private sector dip, it will mark the extension of a gradual trend observed last year, where lending slowed down to touch near 0% in October, on the back of high interest rates, increased non-performing loans, and suppressed business activity. The central bank data shows that during the year to March 2025, the stock of loans lent to private businesses grew at a slower pace of 0.2% to 3.8 trillion shillings compared to a growth of 7.9% that was recorded in the previous period ending March 2024. Last week, the central bank implemented a sixth straight cut on the benchmark rate from 10% down to 9.75%, piling pressure on commercial banks to lower their lending rates in the broader effort to revitalize lending to the private sector. The central bank has now cut its lending rate by a cumulative 3.25 percentage points, and that is since August last year when it commenced easing its monetary policy stance. Despite the deep cuts in the central bank rate, commercial banks have been slow to review their lending rates downwards, and in the process, this has dampened the growth of credit to the private sector, whilst escalating the rate of loan defaults and the ratio of gross non-performing loans. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share it with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, it is often the small steps that bring about the most lasting change. Think about it. Thank you, and God bless.